If you're thinking about buying a house, you've probably wondered, how much house can I really afford? Well, you're in the right place. Today we're going to break down affordability calculations and help you figure out a budget in a way that hopefully makes sense. And when it comes to buying a home, affordability is more than just looking at the sale price. It's about balancing your monthly payments on your mortgage, your income, and all the other costs that come along with owning a home. So what exactly do we mean by affordable? Well, there are two sides of this. There's firstly how much you're comfortable paying each month without stretching your budget too thinly. And secondly, there's how much a lender believes you can afford to pay each month. And these two figures are often very different. Now, to begin with, let's look at your personal budget and determine how much you can afford each month. A good rule of thumb when figuring out what you can afford is the 28-36 rule. And here's how it works. 28% of your gross monthly income should go toward your mortgage payment. This includes the principal and the interest on the mortgage, and 36% of your gross monthly income should cover all of your debt payments, including the mortgage, car loans, credit cards, student loans, and anything else you've got on finance. So let's say your gross monthly income is £3,000. According to the 28% rule, your mortgage payment should ideally be no more than £840, and the 36 rule states that your debt payments combined should stay below under £1,080 ideally. Using these percentages as a guideline helps as a starting point. But everyone has different ideas and different priorities, and I'd always recommend completing a full budget planner, considering all the running costs of the home, such as your recreational spend, hobbies, going out, saving for holidays, and ensuring there's still room for a budget to save in case of emergencies. From your budget planner, you'll have a monthly amount in mind for your mortgage payments, and you can use them with an online calculator or speak to a whole of market mortgage broker to understand what that equates to as a borrowing amount. Now let's talk about how the lenders calculate what they'll be willing to lend. Firstly, a lender will have a maximum loan to income multiple, which can typically be anywhere from 4 to 6 times your gross income. However, this is just maximum they could lend. They'll lend you their own calculation to ensure the mortgage payments for the amount requested are going to be affordable for you, and not put you in a position where you're struggling to pay your mortgage, either now or in the future. A lender will typically look at the following when determining affordability. Firstly, the amount and term of the mortgage, how many people are applying, and anyone dependent on your income. And this does include adults as well as children. They'll consider how much of any monthly loan repayments you've got, including student loans deducted from your payslip. They'll also want to understand how much you've got outstanding on your credit card balances at present. They'll want to make sure they include the cost of any ground rent or service charge that will be payable once the mortgage starts. And they'll also consider things such as childcare or school fees. Some lenders may go into further detail, such as your regular household spending. However, for the majority of lenders these days, they'll assume some figures for this based on the Office of National Statistics. The lender will then review these income and outgoing amounts, along with the mortgage amount that you're looking to borrow and the mortgage term, and determine what they believe is an affordable monthly payment. When considering the mortgage, it's important to note they're not using it based on today's interest rates, but a higher stress rate, which are determined by the individual lender. Another factor a lender will take into account is how long you're initially fixed for, with some lenders willing to lend more when you fix for 5 years or longer, due to the security of payments not increasing during that initial period. The way a lender treats affordability calculations can be very different. We did some research based on an example of a couple earning £94,000 per year. They're in their early 30s, they've got no unusual outgoings, they do have a balance of £4,000 on their credit cards, and they're looking to buy a flat with ground rent and service charge payable of £120 a month. We found the amount available on a mortgage varying wildly from £338,000 all the way up to £517,000 depending on which lender we approach. It just shows you how important shopping around is. Now, you may be in a great position, having completed your budget planner, checked with a lender, and the lender suggests you could potentially borrow more than you initially expected. A little word of warning, just because you're approved for a high amount doesn't mean you should max it out. Stick to your budget and make sure your payments fit your lifestyle. Know your limits. It's easy to get excited about a bigger house, but remember that you still need to live within your means. Factor in future expenses. Don't forget your family size, your income changes, or even repairs might increase your expenses over time. Talk to a financial advisor. A professional home market mortgage advisor can help you navigate finances and make a plan that works for you. I hope this video helps you feel more confident about the home buying process and gives you the tools to find a home that fits your budget.